Welcome to Life Insurance Exam 2025. This is part 1 of 4 in our complete life insurance exam masterclass. Welcome to this comprehensive guide on passing the life insurance exam. Whether you're just beginning your journey into the insurance industry or looking for a structured way to study, this masterclass will give you everything you need to succeed. Over the next few hours, we'll break down every critical topic, explain complex concepts in simple terms, and provide real-world examples to help reinforce your understanding. By the end of this course, you'll not only be prepared to pass the exam, but you'll also have a solid foundation to start your career in the life insurance industry. Let's start with an overview of the exam itself. The life insurance exam is designed to test your knowledge of fundamental insurance concepts, policy structures, laws, and ethical practices. The purpose of the exam is to ensure that all licensed agents understand the principles of life insurance, the responsibilities of an insurance professional, and the laws that protect consumers. This exam is required for anyone looking to become a licensed life insurance agent. Whether you plan to sell policies independently, work for an agency, or offer life insurance as part of a broader financial services career, passing this exam is your first step. While the exact format of the test varies by state, most life insurance exams follow a similar structure. You can expect multiple choice questions that cover topics such as types of life insurance, policies, policy provisions and riders, underwriting processes, state and federal regulations, taxation, and ethical considerations. The test is usually taken at a designated testing center or online through an approved provider, and you'll need to achieve a minimum passing score, typically around 70% depending on your state, so be sure to check. Now let's talk about how to prepare effectively. The best way to approach this exam is with a structured study plan. Break your studying into sections and focus on one topic at a time. Use a combination of study materials, including textbooks, flashcards, practice exams, and audio lessons. It's essential to not just memorize facts, but to truly understand the concepts. This will help you apply your knowledge to real-world scenarios, which is critical since the exam often includes situational questions that test your ability to think like an insurance professional. One of the biggest mistakes people make when preparing for this exam is underestimating the complexity of the material. Many assume that because life insurance is just one type of financial product, the test will be straightforward. However, the exam covers a wide range of topics, including contract law, tax regulations, and risk management. Another common mistake is cramming at the last minute. Life insurance concepts build on each other, so it's important to pace yourself and review regularly. Taking full-length practice exams under time conditions can also be a game changer. It will not only help you get comfortable with the format, but also highlight areas where you need more review. Finally, be aware of tricky wording in exam questions. Many questions are designed to test your attention to detail, so always read carefully and watch out for qualifiers like always, never, and except if you don't know an answer. Use logic to eliminate incorrect choices. Sometimes understanding what isn't correct or can lead you to the right answer. With the right preparation, passing this exam is completely achievable. Now let's dive into the fundamentals of life insurance, starting with the basics of how insurance works. At its core, insurance is a financial tool that helps individuals and businesses manage risk. It provides a safety net that protects people from financial loss due to unexpected events. In the case of life insurance, it ensures that a person's loved ones are financially secure in the event of their passing. But how exactly does insurance work? The concept of insurance is based on the transfer of risk. When someone purchases a life insurance policy, they are shifting the financial burden of a potential loss, such as the loss of income due to death, to an insurance company. In exchange, the policy holder pays a premium, which is a set amount of money, either monthly, quarterly, or annually. If the insured person passes away while the policy is in force, the insurance company provides a death benefit to the designated beneficiary, helping to cover expenses like funeral costs, outstanding debts, or lost income. For an insurance company to offer coverage, certain conditions must be met. This is where the elements of insurable risk come into play. Not every type of risk is insurable. To qualify, risk must be measurable, predictable, and financially significant. This is why life insurance is based on statistics and mathematical calculations. Insurance companies rely on something called the law of large numbers to determine the likelihood of a claim being paid. This principle states that the larger the group of insured individuals, the more predictable losses become. In other words, by insuring thousands or even millions of people, an insurance company can accurately estimate how many claims it will have to pay, allowing it to set fair and sustainable premium rates. Another fundamental concept concept in life insurance is insurable interest. This means that for someone to take out a life insurance policy on another person, they must have a financial stake in that person's life. For example, a spouse, a business partner, or a parent can take out a life insurance policy on someone because they would suffer a financial loss if that person passed away. Without insurable interest, the system would be open to fraud, such as people taking out policies on strangers purely for profit. To better understand life insurance, it's important to get familiar with some key terminology. First, we have the policy holder, which is the person or entity that owns the policy. This is not always the same as the insured person. Then we have the insured, who is the person whose life is covered by the policy. If the insured passes away while the policy is active, the insurance company pays out a death benefit to the beneficiary, who is the person or organization designated to receive the payout. The face amount of the policy refers to the stated amount of coverage, which is typically the sum paid out upon the insured's death. Now let's take a moment to understand how life insurance helps create financial security. Life insurance is more than just a product, it's a long-term financial planning tool for families. It provides income replacement, ensuring that dependents can continue their standard of living even after a wage earner passes away. For businesses, life insurance can protect key employees, fund buy-sell agreements, and ensure continuity in case of an unexpected loss. And for individuals, policies with cash value components can serve as a financial asset, providing liquidity, tax advantages, and even borrowing opportunities. Ultimately, life insurance is about protecting what matters most. It's a way for people to ensure that their loved ones are taken care of and that financial obligations don't become a burden during difficult times. Now that we've covered the basics, we'll move on to the different types of life insurance policies and how they work. Now that we've covered the fundamentals of life insurance, it's time to dive into the different types of policies available. This is one of the most critical areas to understand for the exam, because each type of life insurance serves a different purpose, meets different financial needs, and comes with its own unique structure. By the end of this chapter, you'll have a solid understanding of which policies provide temporary versus permanent coverage, how cash value works, and when a particular type of policy might be the best fit for a client. Another type of permanent coverage that offers more flexibility is universal life insurance. Unlike whole life, which has fixed premiums and guaranteed cash value growth, universal life gives the policyholder the ability to adjust their premiums and death benefit over time. This is made possible because universal life policies separate the cost of insurance from the cash value. The policyholder can choose to pay more into the cash value, or if times get tough, use the accumulated funds to cover premiums. There are different variations of universal life insurance as well. A traditional universal life policy earns a set interest rate on the cash value, similar to a savings account. A more modern option is indexed universal life, where the cash value is tied to the performance of a stock market index such as the S&P 500. This means there's the potential for higher returns but also more risk. Another variation is guaranteed universal life G, which strips away most of the cash value component in exchange for lower predictable premiums and a guaranteed death benefit. Goal is often chosen by clients who want permanent coverage without the investment risk of traditional universal life. Taking investment risk one step further, there's variable life insurance, which allows policyholders to invest the cash value in mutual fund-like sub-accounts. This means the cash value can grow significantly if the market performs well, but it also comes with the risk of losing value if the market declines. Because of this investment component, variable life insurance is classified as a securities product and requires both an insurance license and a securities license to sell. Beyond these major categories, there are a few specialty life insurance policies worth noting. Survivorship life insurance, also known as second to die insurance, covers two people under one policy and only pays out after both insured individuals have passed away. This is commonly used for estate planning as it helps cover estate taxes or leave an inheritance for beneficiaries. There's also joint life insurance, which is similar but pays out after the first death, making it a popular option for married couples. For those looking for smaller policies specifically designed to cover funeral and burial costs, final expense insurance, sometimes called pre-need insurance, provides a low face amount, typically between $5,000 and $25,000, to help ease the financial burden of end-of-life expenses. Additionally, credit life insurance is a type of policy tied to a loan, ensuring that if the borrower passes away, the outstanding debt is paid off. Understanding all of these different policy types is essential for passing the life insurance exam, and more importantly, for guiding future clients toward the best policy for their specific needs. As we move forward, we'll take a closer look at policy provisions, riders, and options, some of the finer details that will help you fully understand how life insurance policies function in different situations. To make things simple, let's start with the most basic type of life insurance: term life insurance. Term life is exactly what it sounds like: coverage that lasts for a specific term or period of time, such as 1, 0, 20, or 30 years. If the insured passes away during that time, the policy pays out a death benefit to their beneficiary. If they outlive the term, the coverage simply expires and there is no payout because it offers pure death benefit protection with no savings or investment component. Term insurance is usually the most affordable option, making it ideal for young families, individuals with mortgages, or anyone looking for high coverage at a low cost. Now, within term life insurance, there are a few variations. One of the most common is level term insurance, where both the death benefit and the premiums remain the same throughout the policy's duration. For example, let's say a 35-year-old buys a 20-year $500,000 level term policy. If they pass away at any point in those 20 years, their beneficiaries will receive the full $500,000. However, once those 20 years are up, the policy simply expires unless renewed or converted. Another type is decreasing term insurance, which works a little differently. Here, the death benefit decreases over time, typically in line with a debt like a mortgage. This type of policy is often used as mortgage protection, since as the homeowner pays down their loan, the amount of life insurance coverage decreases proportionally. Since the payout shrinks over time, these policies tend to have lower premiums than level term. On the other end of the spectrum, there's increasing term insurance, where the death benefit actually grows over time. This type of policy is less common, but it can be useful in cases where a client anticipates their financial responsibilities increasing in the future. The idea here is that inflation and future financial obligations, such as sending children to college, may require more coverage down the line, so the benefit amount gradually rises. Beyond the different structures of term life insurance, there are two important features that may appear on the exam: renewability and convertibility. A renewable term policy allows the policy holder to extend their coverage at the end of the term without having to undergo a medical exam. This means that even if their health has declined, they can still get covered, though at a higher premium based on their current age. Meanwhile, a convertible term policy provides the option to switch from term coverage to permanent policy, again without proving insuranceability. This is particularly useful for someone who starts with an inexpensive term policy but later decides they want lifelong coverage. Now, while term life is great for affordability and short-term needs, it has one major downside: it does not build cash value. That's where permanent life insurance comes into play. Like term policies, which eventually expire, permanent life insurance provides coverage for the insured's entire lifetime as long as the premiums are paid. These policies also include a cash value component, which grows over time and can be accessed while the policy holder is still alive. One of the most well-known types of permanent insurance is whole life insurance. This policy offers a fixed premium, a guaranteed death benefit, and a cash value that grows at a steady guaranteed rate. Essentially, a portion of each premium goes into this savings component, and over time it accumulates tax deferred. The cash value can then be borrowed against or even withdrawn, making whole life insurance both a protection tool and a financial asset. Within whole life insurance, there are different ways to structure the payments. A traditional whole life policy requires level premiums for the life of the policy. A limited pay whole life policy, on the other hand, allows the policy holder to pay off the entire policy in a set number of years, such as 10 or 20, after which no further premiums are required. A single premium whole life policy takes this concept a step further by funding the entire policy with one large upfront payment. While single premium policies require a significant initial investment, they immediately build substantial cash value and can be a great option for estate planning. Now that you have a solid understanding of different types of life insurance policies, it's time to explore the specific provisions, options, and riders that can be added to a policy. This chapter is essential because life insurance isn't just about choosing between term and permanent coverage. It's also about understanding how policies function after they are issued. Every life insurance contract includes standard provisions that define the rights and responsibilities of both the insurer and the policyholder. In addition, there are optional benefits known as riders that can be added to customize a policy. These details will show up on the exam, and more importantly, they'll help you explain policy features to future clients with confidence. Let's start with policy provisions, which are the standard clauses included in every life insurance contract. These provisions establish the rules of the policy, outline the insurer's obligations, and protect both the policyholder and the company from misunderstandings. One of the most important provisions is the entire contract clause. This clause states that the policy itself, along with any attached application and riders, makes up the complete agreement between the insurer and the policyholder. Nothing outside of this written contract can be considered legally binding. This protects both parties by ensuring that only the official terms of the policy apply. No verbal agreements or written promises. Another key provision is the incontestability clause. Life insurance companies want to ensure that applicants provide truthful information when applying for coverage. However, mistakes or misrepresentations can happen. The incontestability clause gives the insurer a specific time frame, usually 2 years, to investigate and deny a claim. If fraud or misrepresentation is discovered after this period, the insurer cannot contest the validity of the policy, even if they later find out that the applicant provided false information. This protects beneficiaries by ensuring that an insurer cannot deny a claim indefinitely. The grace period provision is another important feature. It provides the policyholder with extra time, typically 30 or 31 days, to make a premium payment after it is due. If a policyholder forgets to pay on time, this provision ensures that their coverage isn't immediately cancelled. If the insured passes away during the grace period, the death benefit will still be paid out minus the overdue premium. Similarly, the reinstatement provision allows a lapsed policy to be restored under certain conditions. If a policyholder's coverage lapses due to non-payment, most insurers allow reinstatement within a certain time frame, typically 3 to 5 years, as long as the policyholder pays back the missed premiums and provides proof of insurability. Reinstating a lapsed policy is often more affordable than purchasing a new one, especially if the insured's health has declined. Another critical provision is the misstatement of age or gender clause. Life insurance premiums are calculated based on an applicant's age and gender, so any misrepresentation in these areas can affect pricing. If an insurer discovers that an applicant's age or gender was misstated, they won't cancel the policy. Instead, they will adjust the death benefit to reflect what the correct premium would have purchased. For example, if a policyholder claimed to be younger than they actually were, the insurer would reduce the payout to match the amount of coverage their premiums should have got. Next, let's talk about policy options, which allow policyholders and beneficiaries to decide how certain aspects of the policy are handled. One of the most important is the settlement option, which determines how the death benefit is paid out when the insured passes away. The most straightforward option is the lump sum payout, where the beneficiary receives the entire death benefit in a single tax-free payment. This is the most commonly chosen option because it provides immediate access to funds. However, some beneficiaries may prefer a structured payout instead. For those who want the insurer to manage the funds, there's the interest-only option. In this case, the insurance company holds the death benefit and pays the beneficiary only the interest it earns. This can be useful when a beneficiary doesn't need the full amount right away but wants a steady stream of income. Another alternative is the fixed period option, where the death benefit is paid out over a specific time frame, such as 10 or 20 years. If the beneficiary passes away before the full amount is distributed, the remaining payments go to a secondary beneficiary. Similarly, the fixed amount option allows the beneficiary to receive payments in a fixed dollar amount until the benefit is exhausted. For beneficiaries who want guaranteed lifetime income, there's the life income option, which functions like an annuity. The insurer calculates payments based on the beneficiary's life expectancy and guarantees payments for as long as they live. However, if the beneficiary passes away early, the remaining balance is typically kept by the insurer unless a life income with period certain option is chosen, which guarantees payments for a minimum number of years. Now let's move on to policy riders, which are optional benefits that can be added to policy for extra protection. Riders allow policy holders to customize their coverage based on their specific needs. One of the most common riders is the waiver of premium rider, which ensures that if the insured becomes totally disabled, they won't have to pay premiums to keep their coverage in force. This rider is particularly valuable because a disability could make it difficult for the policyholder to earn income, and without it they might struggle to keep their life insurance active. Another popular option is the accelerated death benefit rider, which allows the insured to access a portion of their death benefit if they are diagnosed with a terminal illness. This can help cover medical expenses, hospice care, or other end-of-life costs. Typically, the insurer will pay out up to 50% to 75% of the death benefit in advance, reducing the amount that the beneficiary will receive after the insured passes away. For families with young children, the child term rider provides coverage for the insured's children under the same policy. This rider is typically low cost and provides a small death benefit if a child were to pass away. Additionally, many child riders include a conversion feature, allowing the child to convert the coverage into a permanent policy without proving insurability once they reach adulthood. The accidental death and dismemberment (AD) rider provides an additional payout if the insured dies in an accident or suffers a serious injury such as the loss of a limb, because accidental deaths are often sudden and unexpected. This rider provides extra financial protection in cases where the insured's death was not due to natural causes. Another useful rider is the guaranteed insurability rider, which allows the policy holder to purchase additional coverage at specified ages or life events such as marriage or the birth of a child without needing to provide evidence of insurability. This is particularly helpful for younger policy holders who expect their insurance needs to increase over time. Understanding these provisions, options, and riders is crucial for passing the life insurance exam and for advising clients in the real world. Every policy is different, and having the ability to explain how a contract functions, how payouts can be structured, and how additional benefits can be added will make you a more knowledgeable and trusted professional. In the next chapter, we'll take a closer look at underwriting and risk classification, the process insurers use to determine how much a policyholder will pay for their coverage. Now that we've covered the different types of life insurance policies and how they function, it's time to take a closer look at how insurance companies determine eligibility and pricing. This process is called underwriting, and it plays a crucial role in the industry. Underwriting is how insurers assess an applicant's risk level to determine how much they should pay for coverage, or if they qualify for coverage at all. Every applicant is unique, and insurers rely on a variety of factors to make these decisions, including health, lifestyle, and financial history. Understanding the underwriting process is essential for passing the life insurance exam because it directly impacts policy approvals, premiums, and risk classification. More importantly, if you're selling life insurance, you'll need to explain to clients why they receive certain rates and what factors influence their policy options. At its core, underwriting is all about risk assessment. Insurance companies are in the business of managing risk, so they need to determine the likelihood that an applicant will pass away while their policy is in force. The higher the risk, the higher the premium, or the greater the chance the insurer may decline coverage altogether. This is why applicants go through an evaluation process, which includes a medical review, financial assessment, and lifestyle analysis. Let's start with the most common method of underwriting: medical underwriting. This is the process where the insurer evaluates an applicant's health to determine their insurability. Most policies require applicants to complete a medical questionnaire which asks about past and present health conditions, prescription medications, family medical history, and lifestyle habits. For larger policies or older applicants, insurers may also require a paramedical exam, which is a basic health checkup conducted by a licensed medical professional. This exam typically includes measurements of height and weight, a blood pressure check, and sometimes a blood and urine test to screen for conditions like diabetes, high cholesterol, or drug use. In some cases, insurers may also request additional medical records from the applicant's physician, known as an attending physician's statement. If there are concerns about a specific health condition such as heart disease, cancer, or past surgeries, the APS provides more detailed information that helps the insurer make a more informed decision. Another key component of underwriting is the Medical Information Bureau MIB report. The MI is a database that insurers use to share and access information about past insurance applications. If an applicant has applied for life insurance before and was denied or rated at a higher premium, that information is recorded in the MIB. This helps insurers detect inconsistencies or undisclosed health issues that could indicate fraud or misrepresentation beyond medical history. Insurers also look at an applicant's lifestyle choices. Certain habits and behaviors can significantly increase risk, leading to higher premiums or even policy denials. For example, smokers typically pay much higher premiums than non-smokers because smoking is linked to serious health risks like lung disease and heart failure. Similarly, heavy alcohol use, drug use, or a history of risky hobbies such as skydiving, scuba diving, or racing can lead to increased rates. Another factor that plays a role in underwriting is occupation. Some jobs come with a higher level of risk than others. For instance, construction workers, firefighters, police officers, and pilots are considered higher risk applicants because of the dangerous nature of their work. On the other hand, an office worker or a teacher would likely receive more favorable rates because their job poses minimal physical risk. Financial underwriting is another important aspect of the process, especially for large policies. Insurers need to ensure that the amount of coverage applied for is reasonable based on the applicant's income, assets, and financial situation. This prevents overinsurance, where someone takes out an excessive amount of coverage that might create an incentive for fraud. Typically, insurers have income replacement guidelines, meaning they will approve coverage up to a certain multiple of an applicant's annual income, often 10 to 20 times their salary. For business owners, financial underwriting may also include reviewing company financials, tax returns, or business valuation reports. Once all of this information is gathered, the IR classifies the applicant into a risk category, which determines the premium they will pay. There are four main risk classifications used in life insurance underwriting. At the top is the preferred plus or super preferred category, which is reserved for applicants in excellent health with no significant medical history, ideal weight, and no risky lifestyle habits. These individuals qualify for the lowest premiums available. Next is the preferred category, which is for individuals who are in very good health but may have minor risk factors such as slightly elevated cholesterol or a family history of illness. They still receive low rates but not as low as preferred plus. The next tier is the standard category, which is for applicants in average health with no major medical conditions but may have a few risk factors such as slightly high blood pressure or being overweight. This category represents the most common risk classification for those with higher health risks. There is the substandard category, sometimes referred to as rated policies. These applicants may have a history of chronic illness, obesity, or other medical concerns that increase their risk. Instead of being declined, they may still receive coverage but at a significantly higher premium. For applicants who pose an extreme risk, such as those with terminal illnesses or severe medical conditions, coverage may be declined altogether. However, in some cases, these individuals may still qualify for guaranteed issue policies, which do not require medical underwriting but come with higher premiums and lower death benefits. Apart from traditional underwriting, some policies use a simplified or accelerated underwriting process. Simplified issue life insurance allows applicants to qualify for coverage by answering a short health questionnaire with no medical exam required. While approval is faster, premiums are typically higher because the insurer takes on more risk. Without a full medical evaluation, an even more lenient option is guaranteed issue life insurance, which provides coverage with no health questions or medical exams. These policies are often marketed to seniors or individuals with serious health conditions who might not qualify for traditional coverage. However, they usually come with graded benefits, meaning the full death benefit is not available until after a waiting period, typically 2 to 3 years. If the insured passes away before this period, the policy only pays out the premiums paid plus interest. Technology has also brought about accelerated underwriting, which allows insurers to approve policies much faster by using big data and predictive analytics instead of requiring medical exams. By analyzing electronic health records, prescription databases, and other digital information, insurers can approve applicants within minutes instead of weeks. This method is becoming increasingly popular, especially for younger healthy applicants looking for quick coverage. Understanding the underwriting process and risk classification is critical for passing the life insurance exam. It's one of the most complex but essential topics in the industry because it directly impacts how policies are priced and issued. Now that you have a clear understanding of how insurers assess risk, we'll move on to another important topic: the different types of beneficiary settlement options and how life insurance benefits are paid out. This concludes this part of the masterclass. Review the concepts, test your knowledge, and continue to the next lesson.